CPI report more than reverses the negativity of the jobs report. Are investors really losing faith in the Indian markets? And why Adobe's recent weakness is a beautiful opportunity for long term investors. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. We are on episode 111. The focus of the US markets last week was on December CPI report. I did tell you guys, I give you a heads up when I discussed last week the jobs report that all attention of the markets would be on the CPI report, and that's exactly how it transpired. And after a remarkable jobs report, inflation simply had to be spot on. If there was any hope for investors that the Fed's stance on rate cuts would change, and for the treasury yields to calm down. Remember, treasury yields were the biggest sort of villain for equity markets last week. Once they had a blockbuster jobs report, treasury yields spiked. You had a negativity around the equity markets. There was massive sell-off, and so inflation just simply had to be spot on. If treasury yields had to come down, and if Fed stance on rate cuts had to change. Thankfully, that's exactly what we got, and boy, did the markets rejoice once the dust settled for the week. And what a difference a week makes, guys. All three indices ended very strongly in the green. The Dow jumped 3.7%, S&P 500 jumped 2.9%, and the tech-heavy Nasdaq finished the week up 2.5%. So all in all, a fantastic finish to the week, a fantastic week overall for the markets. And like I said, what a difference a week makes. Last week was pretty bad. Sorry, 2 weeks ago was pretty bad. Last week was pretty good. Who knows what the week ahead lies? So let me welcome you to the first segment, Doctor's Weekly Snapshot, as always, where I can discuss the December CPI print and what it means for the Fed and for the investors. Firstly, before I go into all the implications, so we are in the Doctor's Weekly Snapshot. Before I move into the implications and before I give you my take on what the CPI print really means for investors and for the Fed, let's discuss the specifics on the report, right? The numbers. On the face of it, the December CPI print showed inflation came in hot. December CPI showed that inflation rose 2.9% year over year and 0.4% month over month. And the reason why I say that overall inflation did come in hot was both these figures were ahead of what economists were expecting. I mean, economists expected inflation to rise 2.7% on a year-over-year basis and 0.3% on a month-over-month basis. In reality, inflation rose 2.9%, so that's a 0.2% difference. And on a month-over-month basis, it was 0.4%, so that's a 0.1% difference. So overall, when you look at it, inflation was hot. Now, the reason why markets decided to rejoice in markets, there was more positivity among the markets despite a hotter inflation report, was because of the core inflation. Okay, so markets, instead of deciding to focus on the main print, decided to focus on the core inflation reading, which, as you know, excludes volatile items such as food and energy. This is where, the core inflation is where there was much to be positive about. More specifically, core inflation in December rose 0.2% month over month, marginally declining from the 0.3% month over month gain seen for the last 4 consecutive months, including November. Even on an annualized basis, there was a marginal decline in this metric, with core inflation rising 3.2%, down from the 3.3% in November and falling short of the 3.3% consensus, which means, this time falling short is actually good. Everyone was expecting core inflation to come in at 3.3. Reality came in 3.2. A cooler core inflation is obviously good, and that's where the markets decided to focus all their energy on and all their positivity on. The different direction that core and overall inflation took, remember, inflation was hotter, core inflation was cooler, and the different direction that core and overall inflation took in December is actually not surprising. And this is because the primary driver of December inflation were energy prices. They climbed 2.6% in December. Gasoline price index jumped 4.4% month over month. And given that this is excluded from the core index, it is natural to see a decline in this metric in the core inflation while the overall inflation accelerated. So you add the gasoline index and you have an accelerating inflation. You exclude the gasoline index, which is what the core inflation does, and you have a much better inflation reading, at least from an investor's perspective. Now, apart from rising gas prices, the other good news was that the price of other items continued their downward trend. Owner's equivalent rent, for instance, which represents about a quarter of the overall CPI basket, eased to 4.8% in December from 4.9% in November. So, on all in all, when you really look at the other things other than gas prices, things were in the right direction. So, when you take the gas prices out, and inflation suddenly looks a lot better. And that's where, like I said, investors, markets decided to focus their energy on. And so you had a bout of positivity in the markets. What a difference 1 week makes, right? I keep repeating this phrase, what a difference 1 week makes, because that's true. It is true. It is extremely true, because you can see, after the jobs report there was negativity, markets, there was massive sell-off. And last week, once we had a better than expected core inflation, markets rejoice. And not just that, okay, there's a lot of difference of I keep saying what a difference 1 week means makes I keep saying it because you simply don't need to look beyond the CME Fed Watch tool to see how fickle traders are when it comes to the rate cut expectations. Last episode, I told you, following the jobs report, traders weren't expecting a rate cut at least until May. And even then, it was at what, 55.6%, which is not exactly strong. So they were not expecting, I mean, they were expecting a rate cut in May, but was not exactly, with full conviction. And the odds of zero rate cuts in 2025 prior to the inflation report actually stood at 26%. And this is a very significant figure, in my opinion. Okay, 26% is no figure to be laughed at. Furthermore, prior to the CPI report, the odds of more than one rate cut in 2025 stood at 35%, again reflecting how much the strong jobs report had affected traders' expectations. In fact, how much it affected to the downside. Post the CPI print, the whole picture flipped. And that's why I keep repeating what a difference a week makes. Post the CPI print, the whole picture flipped. The odds of zero rate cuts in 2025 after the inflation report was released actually fell to 16%. Remember, it was at 26, came down to 16%, much better. And the odds of more than one rate cut in 2025 jumped to 50%, which is again a very meaningful jump given that it was at 35% prior to inflation. Now, I told you last week that when I say last week in the last episode, that the December jobs report had made the Fed's job a lot easier by allowing it to focus on just inflation rather than doing a balancing act between jobs growth, economic growth, and inflation. And ahead of the CPI print, we got the minutes of the Fed's December meeting, which actually showed that the Fed officials were bracing for the possibility that Trump 2.0 could take decisions with respect to tariffs and immigration, which could spur inflation again. So they had already, it just simply shows, or in the December minutes of the December meeting essentially says that the Fed was very confident with where economic growth was heading, and their focus was firmly on inflation. And they were worried that inflation could rear its ugly head again, especially if President-elect Trump decides to carry on with his promises, or rather push forward with the promises of with respect to tariffs and immigration. DJT's repeated calls, and DJT Donald J. Trump, DJT's repeated calls for raising tariffs and undertaking a mass deportation program, both of which could put upward pressure on inflation, has most certainly spooked both the economists and the Fed. So much so that Wall Street Journal actually published an article last week which talked about the possibility, a significant possibility, might I add, that the Fed could hike again. Yeah, you heard that right. Hike rates again after chopping 100 basis points off the Fed funds rate. Like last year, when the Fed started its rate cutting cycle, nobody was talking about hikes. Now, the specter of a rate hike is again on the table. And that's primarily because of the potential inflationary impact that the Trump 2.0 Trump 2.0's plans of tariffs and mass deportation could have. Now, while I continue, and I sincerely continue to believe that we won't get a hike anytime soon, I mean, it's frankly ridiculous in my opinion. You can all laugh at me if the hike does happen, but I just don't see it. I just don't see a possibility of a rate hike. Okay, the fact that we are even discussing a rate hike to me is frankly ridiculous. But anyway, moving past my personal opinion, while I continue to believe that we won't get a rate hike anytime soon, the idea of excessive tariffs and mass deportation are factors that should be taken seriously by investors. That I have no doubt about. The good news is we don't have to wait for too long. Yeah, we will get an idea about the new administration's plans on Monday itself, given that nearly 100 executive orders have already been prepared and are expected to be signed on day one. There are also reports that DJT could start his mass deportation program on Tuesday by targeting Chicago. So it's not like we must wait for a long time to see what Trump 2.0 has up its sleeve. Having said that, the notion that tariffs could be a negotiating tactic still cannot be dismissed. Yes, one has to take President elect Trump at his word. He's not one to back off from his promises, and he loves a fight. And given that he has enough governing experience in his as he takes on his as he brings on his new administration, and given that he has a mandate in today's climate, quite honestly, there is nothing stopping him from carrying out his promises. There are talks about the new administration planning to invoke laws which have been not been used in decades to push the twin plans of tariffs and mass deportation. In fact, President-elect Trump even announced that he plans to create an external revenue agency with the sole purpose of managing tariffs. And the president-elect's border czar, Tom Homan, is not one to be underestimated, not one to be messed with. However, having said all of that, given that President-elect Trump contacted the Chinese President Xi Jinping over the weekend and even invited him for his inauguration, does show that the prospect of using tariffs as a negotiating tactic simply cannot be dismissed. Right? You can't with 100% certainty say, oh yeah, this is not a negotiating tactic. He's going to go for it. He's going to go for it. He's going to carry out his tariffs. It's going to be pandemonium. There's going to be a lot of inflationary impact and so on and so forth. I necessarily don't think that one can simply dismiss it. I mean, why else? Why did he call Chinese president then? There's something brewing. There's something brewing in the background for sure. And the good news is we don't have to wait for long. We don't have to wait 6 months down the line. We don't have to wait 12 months down the line. We simply have to wait till Monday. And given the fact that markets are on holiday on Monday, the impact will immediately be felt on Tuesday trading. I can guarantee you that. At least I'm expecting some sort of impact. Whether it's positive or negative remains to be seen. But the markets are definitely going to react from Tuesday onwards on the new administration's plans. There is no doubt about it. They're not joking when they say nearly 100 executive orders have already been prepared. So if you are an investor, the coming week will offer you plenty of insights into how the new administration is planning to play the tariff card. The movement in treasury yields will become even more important for equity investors as they are expected to be extremely volatile with each executive order relating to tariffs and immigration that gets passed. After all, the moderation of yields last week is what drove the equity markets upward. Next week might be a holiday shortened one, but it could still play a major role in shaping the direction of the equity markets for the rest of the year. Ladies and gentlemen, welcome to the Trump 2.0 era, where volatility is the name of the game. On that note, I'm going to take you straight from the United States of America to India. Welcome, ladies and gentlemen, to the Doctor Goes Home segment. So I take a sip of water. Welcome to the Doctor Goes Home segment. By the way, my throat feels better, just so you know. As you can see, I don't need to put as much strain as I had to last week, but I do have to take sips of water, not fully out of, not fully out yet, fully recovered yet, but it's certainly a lot better than it's doing. Right. What shall we talk about? With respect to India. Obviously, we can talk about the Indian markets because we are only 17 days into January, or rather 19 days into January, and Indian equity investors have already had enough of 2025. At least that's the initial impression that you get if you simply look at the Indian markets. It has simply not been a happy new year for both Nifty and Sensex. Year to date, Nifty 50 is already down 2.3% and Sensex is already down 2.4%. Contrast that with the S&P 500, which is up 2.4% during the same period, and you would think that after a stellar 2024, 2025 doesn't appear to be a good one for the Indian markets. At least that's what the foreign institutional investors are thinking as they continue their relentless selling spree, which started towards the end of 2024 and has continued with full force into the new year. To make matters worse, you have the Indian rupee, which is hitting record lows every day. The rupee finished on Friday at 86.6, and there is talk that it might see the upper 90s by the end of the year as the RBI loosens its policy of maintaining a quasi peg to the dollar, as more and more outflows are triggered as a consequence of higher currency risk to the FII. So there is a possibility that they might even stop their policy of selling dollars to maintain the quasi peg to the dollar. I think they're gonna. There is every intention that the RBI, under its new governor, could loosen its policy. So the question then becomes, as an Indian investor, if you are an Indian investor, whether you're foreign or domestic, what's really going on? Is it time to panic? Do we need to switch our attention to other markets? Should I simply stop the doctor goes home segment, as there's no point talking negative news week in and week out? Well, the answer to all those questions, if you ask me, is a resounding no. And that's not for dramatic effect. It is no. No, you don't need to panic. You don't need to switch your attention to other markets. I most certainly, I mean, you are absolutely free to skip the segment if you wish, but I certainly am not going to stop talking about the Indian markets. The doctor goes home segment will continue for the foreseeable future. I mean, it could take monumental, complete, I don't know, I'll have to probably shut down the whole show for me to stop talking about the segment. Nor am I going to sell everything and exit from India completely. My Indian portfolio remains the same. It remains active. I continue to look out for opportunities. And while I'm not an investment advisor, as I keep telling multiple times, I can't give you any investment advice, but if I were you, I would use this time to scout for potential long-term buying opportunities. As I'm saying, I've said this repeatedly in the show, and I continue to say that I'm a perma bull when it comes to India, but that's just me. You are listening to the show for my opinion. What you do with it, throwing it at the bin, taking on board, using some of it, and along with your own investment research, I leave it to you. But I most certainly, I'm not just an advisor yet, investment advisor yet. So I'm not going to give you any investment advice. But I certainly am not going to stop talking about the Indian markets. So feel free to skip the segment, but there's no need to panic. Before I get into why I continue to be optimistic, why I continue to be a perma bull in India, let's take a look at why Indian markets have started 2025 on a negative footing, right? Let's really dig into the problem, okay, before I move into the optimistic. You could basically put the negativity surrounding Indian markets to three key factors, in my opinion: the potential economic slowdown, earnings downgrade, and the potential return of a spike in inflation. You combine all these three, you combine slowing growth, slowing earnings, and spike in inflation, you get the dreaded stagflation, which is nothing but an environment that has slowing growth but high inflation. Let's take each of these factors one by one and let's explore together whether a stagflation in India has a high likelihood of happening. First, economic slowdown. Markets panicked last Tuesday. Investors lost over 12 lakh crores as Sensex tumbled nearly 1,050 points after the Indian government released its advanced estimate for FY25 GDP growth, which showed that the real GDP growth is expected to slow to 6.4% year over year in FY25 from a whopping 8.2% in FY24. Now, the panic was mainly because this came below the Ministry of Finance's projected figure of 6.5% and the RBI's projection of 6.6%. Now, here's why I think there is no reason for investors to worry despite this somewhat dreaded slowdown or dreaded figure. First, this grim advanced estimate figure has come at the right time. And by right time, I mean ahead of the 2025 budget, the first full budget that is going to be presented under Modi government 3.0. The grim estimate means that you are likely to see FM Nirmala Sitharaman unveil growth-inducing measures at the budget. According to an ET analysis, these measures could include tax relief for middle class, tariff measures to shield the industry from the adverse external environment, and initiatives to foster job creation and private investment. There are also stocks for certain automobiles, especially two-wheelers up to 125cc, to have reduced GST, which could also happen. Put simply, there is absolutely no chance of the 2025 budget being what I call stingy. I expect blockbuster stimulus measures which should help the GDP growth to course correct itself. Then you have the Reserve Bank of India, which is likely to initiate its rate cutting program much sooner than anyone, including myself, anticipated. Last week, you had a very interesting report published by the analyst at Deutsche Bank, which predicted a 25 basis rate cut as soon as February and another 25 basis rate cut in April, which will bring the repo rate down to 6% by the time we finish first half of 2025. The report's logic is that monetary transmission, which is basically the effect of the cuts on the economy, works with a considerable lag of at least 3 quarters in India. In other words, if you make a cut in the March quarter, which is February, you are likely to see the impact only by December quarter. As such, there is no sense in waiting till the December quarter to make the cut, especially if the slowdown is on the cards. Now, the automatic question then becomes, what about inflation? Well, there you actually have good news. Last week we got the CPI data, which showed that India's retail inflation cooled to a 4 month low of 5.22% in December versus the 5.48% figure in November, as food prices, which have been inflation's main nemesis, moderated. The actual inflation also came in cooler than estimates, which actually predicted 5.3%. And it was much, much lower than the October figure, which was a 14-month high of 6.2%. Food inflation at the time had reached a 15-month high of 10.9%. Of course, inflation remains well above the midpoint of RBI's target range of 2 to 6%, the midpoint being 4%, and economists don't expect inflation to cool down to those levels until the second half of 2026. That's a long way apart, ladies and gentlemen. Core inflation, however, which does exclude food and energy items, has already come below 4%. It came in about 3.6% in December. But given that food and energy prices are the main villains, one can't really rule them out. Now, one of the factors that actually led to the 1,050-point fall in Sensex on Tuesday was that oil prices had hit a 3 month high, rising above $80 a barrel for the highest rising above $80 a barrel to their highest in more than 4 months. The culprit for the rise in oil was broader US sanctions on Russian oil, which was expected to have an adverse effect on the likes of India and China. Rising geopolitical tensions were one of the main reasons, in addition to food prices, that prevented the RBI from making any rate cuts. But last week saw a major development when both Israel and Hamas finally agreed to a ceasefire deal, which, if executed to the point, could see a grueling 15-month brutal war come to an end. And if that were the case, then it only leaves Russia Ukraine as the last stumbling geopolitical issue. And with Trump 2.0 set to kick off from Monday, I do expect there to be some resolution in that situation in the coming months. At least that's what I'm betting on. So when one really looks at the situation, the geopolitical risks are actually decreasing, in my opinion, and not increasing, which is good news for importers like India, as it means that crude prices could very well be kept in check. Add to this the bumper harvest season, which have brought food prices down, and you can make a reasonable bet, according to me, that the two major inflation drivers are actually moderating. When you factor this along with a slowing growth, then there's absolutely no reason for Reserve Bank of India not to start its much anticipated rate cutting cycle. And you combine a rate cutting cycle with budget stimulus, you can see GDP growth, once again, like I said before, course correcting. So, inflation fears overblown, growth slowdown dealt with. This brings us to the third problem facing the Indian markets: earnings downgrade. Now, this is definitely a concerning theme, okay? Probably the only one. As I have already addressed, inflation fears are overblown, and I've already given you enough reasons to know, to at least believe that the growth will course correct itself. Now, as far as earnings downgrade is concerned, that's a real concerning problem, because after 4 consecutive years of healthy double-digit growth, India Inc. witnessed an earnings downgrade in the last 2 quarters. And Q3 is expected to be no different, with analysts seeing FY25 full-year earnings growth in single digits. However, again, there is a solution here as well. The start to the earnings season, if one really looks at it, has actually been solid. Major IT giants such as TCS and Infosys all reported strong profit growth, with Infosys even upping its revenue guidance. On top of this, you had the most valuable company in India, Reliance Industries, also smash street estimates. And then on Friday, you saw Indian Hotels, one of my long term holdings, seeing its net profits jump 23%. While it's early days and you still have the financial heavyweights and auto giants left to report, I would say it's been a very decent start to the earnings season. I think robust would be a better word. And when you factor in potential stimulus measures from the budget, then even if the most recent quarter, even if Q3 doesn't live up to expectations, future earnings would certainly benefit from these stimulus measures. So, again, all in all, when you take all these factors, less reason to panic, in my opinion. Bottom line, ladies and gentlemen, as I wind down this segment, I am not saying that there are no reasons to worry about the current state of the Indian markets and Indian economy by extension. Despite the recent sell off, Nifty continues to remain expensive relative to its historical levels. Its forward price to earnings currently stands at 21.4, well above its long term historical average of around 16.2. The concerns that have driven FIIs to keep selling, the ones I've already talked about today, are legitimate and concerning. However, dig deep and you'll notice that these issues are not structural but rather transitory. Now, where have you heard that before? Long term, India's growth story, in my opinion, remains intact. The budget is likely to offer enough measures, in my opinion, that would boost long term growth, which should subsequently drive future earnings growth of India Incorporated. The RBI, and I can't believe I'm saying this, but it does look like the RBI will begin its rate cutting cycle sooner than later. This is because growth is under pressure and inflation, while it does remain elevated today, does appear to be heading in the right direction once more now that food prices have finally started to moderate. As such, from a long term perspective, I continue to remain bullish on the Indian economy and the Indian stock markets. The only difference from my previous views is that India has become a stock pickers market rather than a market where you simply invest in the Nifty overall. Q3 earnings will more likely reflect this change of stance, as in this sticky environment, the winners will clearly differentiate themselves from the losers. And I don't need to state the obvious, but I'll say it nonetheless. Stick with the winners and dump the losers. And on that note, ladies and gentlemen, let's head now to the final segment, Dr. Dissects. Right, last week was a retail giant, yeah, right? Last week we discussed a retail giant in Dr. Dissects. This week, we're actually going to talk about an AI stock, AI beneficiary, so to speak. We're going to talk about the software giant Adobe. Now, the reason why Adobe comes under microscope is especially because it has started the year off on a very negative note, which shares under considerable pressure. Last week was good for a software giant, but overall the stock is down 2.5% for the year. And if you stretch it back to a 1 year period, then you'll realize that investors simply have not been a fan of the name, as the stock is down nearly 28% during that time. So, first of all, disclaimer, I'm an Adobe investor, continue to hold Adobe shares. The question then becomes, is this a buying opportunity or is this one to stay away from? Let's take a look at what's happening here. Let's dissect the stock. Now, Adobe reported its Q4 numbers last month, and while it was a beat on both the top and bottom lines, the company's guidance fell short of estimates. The stock, unsurprisingly, fell victim to the softer than expected guidance, with shares tumbling nearly 14% post the earnings release. Now, I find this reaction completely baffling because despite a conservative Q4 guidance in the previous quarter, the company comfortably exceeded the high end of both revenues and the non-GAAP EPS. So this is a company that is known to provide conservative guidance. As such, in my opinion, investors should have taken the FY25 guidance with a pinch of salt rather than taking it at face value, which resulted in approximately 16% drop in the 2 days following its earnings. If one really looks at Adobe's latest quarter, which is Q4, there is actually very little to be disappointed. Both document and creative cloud segments posted double-digit revenue growth. The 16% year-over-year growth seen in RPO, or remaining performance obligations, was also impressive. And the company continues to make meaningful progress with respect to its AI initiatives. Firefly-powered generations across Adobe's tools have now crossed 16 billion, and the company launched the much-anticipated Firefly video model, albeit in a limited public beta mode. The company plans to make this model more broadly available in early 2025. And early signs are already promising, with the integration of Firefly video model in Premiere Pro driving a 70% increase in the number of Premiere Pro beta users. Now, as I mentioned the last time I talked about Adobe, the Firefly video model is where users would consume a substantial amount of generative credits, which I consider to be Adobe's key to unlock direct monetization of Firefly. Moreover, according to verified market research, the text to video AI market is expected to grow at a CAGR of 36% from 2024 to 2031. Furthermore, the company's primary competitor, OpenAI Sora, has not wooed the market yet, despite already being available. Having said that, it is vital that Adobe launches the Firefly video model ASAP. This is because the net new digital media ARR growth has been stuck at 12% in the last 3 quarters. In the first quarter of FY24, this growth was 13%, which means that there has also been a drop off in growth. Now, the lack of acceleration in the ARR growth, in my opinion, can be attributed to the monetization of Firefly hitting a ceiling. This is why not only is it important for the company to start monetizing generative credits, but also ensure that they get the Firefly video model out of the beta version as soon as possible. There was an analyst question during the recent earnings call which suggested that despite all the innovation and monetization avenues that the management was talking about, the growth was heading in the wrong direction. While Adobe CEO Shantanu Narayan did address the question to a reasonable extent, it was more of a qualitative response than a quantitative one. And what was disappointing was that there was no mention of either the Firefly video model or generative credits in his response. As an existing Adobe investor, I do hope that the management unlocks the monetization potential of generative credits real fast. Making Firefly video model mainstream would be key to do that, and FY25 must be the year, in my opinion, when both of this becomes a reality. Otherwise, Adobe risks missing the opportunity to be a significant beneficiary of the AI revolution. Next, while the Creative Cloud is somewhat stuck in a growth limbo, the company has been using its AI tools to help fuel the growth of its Document Cloud business. In Q4, for instance, the Document Cloud saw its revenue surge 17% year over year, and the company's AI assistant, which was introduced in both Acrobat and Reader, has helped users complete their document related tasks 4 times faster on average, thereby driving productivity. The company during the fourth quarter also introduced specialized AI for contracts and scanned documents, as well as AI tools to analyze larger documents. All of these tools not only led to a 23% year over year growth in Document Cloud ARR, but also resulted in a 25% year over year growth in monthly active users, with the number of paid and free users surpassing 650 million. The way the AI tools have fueled the growth of Document Cloud is further proof for why the company needs to roll out the Firefly video model from the beta version, as well as monetize the use of generative credits ASAP. And I repeat, ASAP. Can't wait. 2025 has to be the year. In fact, the sooner in 2025, the better. Notebook ready, pen ready. That can only be one thing: valuation. So we're now going to discuss Adobe's valuation. Now, company expects FY25 non-GAAP EPS to come in between 2030, $20.30, $20.50. Consensus estimate for FY25 is $20.52. In the last 5 years, the company has on average beat analyst estimates by 0.75%. Let's assume the company exceeds the FY25 estimate by 0.75%, then projected FY25 EPS would be $20.67. This is what I've estimated for my calculations. Now, 20.67 projected FY25 EPS. Now, this is lower than my previous estimate of 21.30 because my current estimates translates to a year-over-year earnings growth of 12.2%, which is much lower than my previous growth projection of 16.5%. And this lower growth projection is primarily because of sort of the lack of urgency when it comes to monetizing generative credits. I'm actually quite disappointed as an investor with regard that they've not like kind of hurried along with regards to this. Now, the company currently trades at a forward price to earnings ratio of 22.97x according to LSEG data. This makes Adobe the cheapest amongst its peers, with the likes of Salesforce, Oracle, SAP, and Autodesk trading at much higher multiple. The median forward price to earnings multiple of its peer universe stands at 29.3x. Even relative to its historical multiples, the company is currently cheap, with its 2-year, 5-year, and 10-year median price to earnings multiples trading at 26.9, 31.1, and 30.8, respectively. Given the surge in demand seen for its products, which has been driven by the addition of Firefly, and given that the company continues to convert free users to premium users on a consistent basis, I do believe that the stock should be trading at higher multiples. As such, I've assumed a projected forward PE of 29.3 times, which is the industry median. This is slightly lower than my previous estimate of 31.3, and this is because there is still no timeline on when the company is going to monetize generative credits. Furthermore, remember, I've estimated a lower earnings growth rate compared to last time, so I have lowered my multiple, and that stands at 29.3. Now you have 29.3x, multiply that by 20.67, and you get a price target of $606. $606 is my updated price target. And while this updated price target is lower than my previous estimate of 667, it still represents an upside of about 41% from current levels. 41% upside from current levels with an updated price target of 606. Given the considerable upside from current levels, I am maintaining a buy rating on the stock. And while this is a downgrade from my previous rating of strong buy, which is, I mean, the strong buy, the downgrade from strong buy to buy is because of a lower price target and negative short-term momentum in the stock. But the rating remains buy, 606 updated price target, 41% upside from current levels. When I issue a buy, ladies and gentlemen, I always talk about risk factors. Why don't we do that now? My risk factors have actually remained the same since the last time I spoke to you guys about the stock. My bull case continues to rely on the Firefly video model, which has to be a success if Adobe needs to take its growth to the next level. Has to be, no doubt. Should the likes of Sora continue to gain popularity, then Adobe could fall behind. Furthermore, the USP of the Firefly video model is that it is expected to be commercially safe. Any glitches on that front could also be a setback to the company. The timing of AI monetization continues to remain a mystery. There was only one mention of generative credits during the Q4 earnings call, that too towards the end. This is certainly a cause for concern, and unless there is a definite roadmap for the rollout of paid generative credits, there is not going to be any serious gain from Firefly. And the lower multiple relative to its software peers will then, in that case, be more than justified under such a scenario, making this uncertainty yet another risk factor to my bull case. To wrap things up, bottom line, it was a great finish to the year for Adobe. The document cloud business continues to generate substantial growth thanks to the AI tools. And the company exiting the year with record remaining performance obligations does suggest that demand for its products continues to remain strong. From a valuation perspective, the post earnings drop has led to a buying opportunity given the considerable upside from current levels. I continue to believe in the long term potential of the company, and I plan to add to my existing position thanks to the post earnings tumble and the subsequent tumble that were witnessed in the stock. Having said that, ladies and gentlemen, I do leave you with this thought that I will continue to actively monitor the timeline of launch of both the Firefly video model and, more importantly, the monetization of generative credits. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on the Stock Doctor Podcast at gmail.com. Thank you once again for listening. I will see you next week as the lights in my office have gone down. I didn't plan this, it just so happened. I will see you next week, ladies and gentlemen. Until then, stay safe and make some money.